It is the passive dividend investor's dream, getting a 10 to 12% annualized dividend yield from a broadly diversified portfolio that includes some of the largest, strongest, hottest stocks in the world like Meta, Alphabet, Apple, Amazon, Microsoft, Nvidia, Tesla, etc., as well as the immediate liquidity of the market, relatively low expense ratios. What's not to like? And certainly a lot of investors do like this pitch. You have covered call ETFs like the JP Morgan Equity Premium Income ETF, that's ticker symbol JEPI, the JP Morgan NASDAQ Equity Premium Income ETF, that's ticker symbol JEPQ. Then NEOS has their sister funds for this. There's SPYI, that's basically the equivalent of JEPI, and then there's QQQI, and that's basically the equivalent of JEPQ. And then Global X obviously has had a similar fund to QQQI and JEPQ and QYLD that's been around for a bit longer. All these funds own broadly diversified underlying holdings that are based off some of the leading indexes. So JEPI and SPYI are loosely based on the S&P 500, and then JEPQ and QQQI and QYLD are all based on the NASDAQ 100 underlying portfolio. And so they hold those underlying portfolios that have done really well over the long term. They're filled with mega cap tech stocks along with some other exciting holdings. They're fully leaning into the AI boom. But then they try to give investors the best of both worlds with that attractive underlying portfolio. They then overlay various covered call strategies on top of that portfolio with monthly options being written to generate premiums, significant premiums in many cases, that they then pay out to shareholders as a monthly distribution. That amounts to a yearly yield in most cases of double digits, 10, 12, 14%, depending on the fund, depending on the moment, with implied volatility. And so a lot of investors love this because it gives them the best of both worlds. They can diversify their income-focused portfolios into these other funds. For example, they may have Schwab US Dividend Equity ETF in there as their core holding. They may have maybe an MLP fund like the Illyrian MLP ETF like AMLP. Maybe they'll have an infrastructure fund like the Reeves Utility Income Fund, ticker symbol UTG. Maybe they'll have some BDCs in there like Eris Capital Corporation or Main Street Capital. Maybe they'll have some REITs like Realty Income or Simon Property Group in there. And that's all giving them very attractive income. But the thing is SCHD does not have any of the mega cap tech stocks in it. Certainly none of those other funds or stocks are going to have that either. And so they want to have a better diversified portfolio because over the past several years, the tech sector has significantly outperformed the dividend sector because of the AI boom. And so a lot of investors have FOMO, fear of missing out, or they simply just want to have that more diversified portfolio. They want to have exposure to some of the world's great tech companies, especially when we're undergoing an industrial revolution like we are with the AI boom. Perfectly understandable. And so they turn to these funds thinking, okay, I can get that exposure while also getting my high yield. And I think that is a valid reason. I'm not opposed to that concept. I think it's fine if a retiree wants to have that fund in their portfolio. However, I do have a strong caution. I think these funds are very overrated and a lot of investors misunderstand what they're buying. And so that's what the rest of this video is going to be about. Before I get into it though, if you like getting regular dividend content, whether it be talking about ETFs like today's video or individual stock picks that I frequently put out or just my overall dividend investing philosophy, I encourage you to please subscribe to this channel. I'm the leader of the top-ranked investing group on Seeking Alpha called High Yield Investor. You can check us out with the link in the video description. Again, if you'd subscribe, I'd greatly appreciate it. Thank you so much. Okay, so why do I think that these covered call ETFs like JEPI and JEPQ and others are so overrated? Well, the big thing is the structural makeup of the fund. And I think a great illustration of this is QYLD because it's been around for a lot longer. Over the long term, QYLD has significantly underperformed the underlying NASDAQ index. And not only has it underperformed it, but its underlying share price, or its NAV, which is what ETFs trade in line with, net asset value, has declined significantly over time. And the reason for that is pretty straightforward. When you write covered calls, especially when you do it pretty much uniformly on the underlying holdings and you do it on a monthly basis, you are effectively trading upside potential in exchange for passive income. And how that works is you write a covered call, say, I don't know, at a 5% premium to where the index is right now. And let's say the index goes up 7% this month. There's a strong rally. So you can participate in that first 5%, but you're giving up that additional 2% on top. And maybe you do that in exchange for a 1% options premium. So yeah, you get that nice income that you're paying out to shareholders, but you're missing out on 2% additional upside in this example. And so the underlying index would generate a 7% total return. You would just generate your 5% appreciation plus your 1% options premium. So you're left behind by 1%. Then let's say the next month you write that covered call again and you get that 1% premium. But this time you have to obviously write it at a higher level because the index is now at a higher level. And so you're having to buy back in after that call is exercised at an even higher level, at a 7% higher level than you had the previous month, right? And so you're buying at that 7% higher level. You write another, call for 1% premium. Great. Unfortunately, this month, the ETF falls back down by 7%. So it's back down to where it was at the end of 2 months to where it was 2 months ago. It's traded flat the whole time. So the underlying NASDAQ has generated a 0% return over that time period. So that first month you had a 6% return. But this month you declined by 7%. Now, yes, you did have that 1% options premium that you get to pocket because it didn't hit the strike price, but you're also down by 7%. And so that shows how there you're even as well. And so sure, you've generated that income, but you're even in your total returns, and you've actually lost 2% of your NAV because the first month you were up by 5, then you were down by 7. And so you lost 2% of your NAV. So you're effectively just cannibalizing the fund with these distributions. And so that's just one example. Now you could make a more extreme example where maybe the fund maybe you wrote just 3% out of the money. You're doing just 3% of the money calls. And so that volatility is even more extreme, and you end up actually being in the negative total returns over those 2 months, whereas the index may be flat. And that, extrapolated over time can lead to negative total returns, or at the very least, in the case of QYLD, they have delivered positive total returns over time, but the underlying NAV, as I just showed in that illustration, erodes over time. And so with QYLD, maybe you're getting a nice income yield, but over time, your NAV is declining. So you effectively have an annuity and not really a dividend investment where you're compounding wealth on your principal as well as your passive income over time. So that's just something to keep in mind. Now, JEPQ, JEPI, SPYI, QQQI, they've tried to tinker with the algorithm a bit to try to avoid some of QYLD's mistakes. And there's some active management components in there, especially in QQQI and SPYI, where they try to do buy calls as well, further out of the money to try to preserve some upside potential during big rallies. They won't always write calls on all the underlying holdings. They'll do different strategies here and there to try to improve their performance. And it has shown in recent years that SPYI, QQQI, JEPQ, JEPI, they have outperformed QYLD a good bit. And so there is something to be said for these new funds. I'm not saying they're complete garbage, but still that structural built is in there, and no one is perfect. No one is going to get it right every month. And so over the long term, you're almost playing a Russian roulette type game where you're taking a gamble that you're going to get burned by rapid volatility. And I think that's especially true with where trading is headed, with information getting disseminated so fast. You have all these algorithmic trading hedge funds and other situations where instantaneously news comes out, the trade happens super fast. You have AI powered stuff that's going to be increasingly operating, and that will autonomously move things extremely fast as well. And so it's going to be very difficult to be able to react to that with human judgment, active management. And on top of that, we're going to see a lot more of these V-shaped recoveries. We had it during COVID where everything crashed and came back quite sharply. You had that this past April in so-called Liberation Day tariffs where the market crashed heavily and then came roaring back quite quickly. And that's the worst possible scenario for these types of funds. And so I think over the long term, at the very least, you're probably going to underperform, and you may very well suffer significant NAV erosion, and ultimately it's going to lead to dividend declines or payout declines by these funds, because as their NAV erodes, there's less there that they can write calls against to generate distributions for shareholders. Again, I'm not saying there's no place for it in a portfolio. I'm just saying that it is highly overrated by many who just see this as some kind of a free lunch where they're getting exposure to underlying mega cap tech stocks while getting these nice distributions. But you're really not. You're capping upside on the one hand, and on the other hand, you're setting yourself up for full exposure to downside risks, and with that, likely long-term NAV erosion. So hopefully this video was useful for you. Again, I'm not trying to scare you out of these funds and say never buy them ever, but I am saying that they are highly overrated, and that if you do hold them, personally, if I were to hold them in my portfolio, which I don't, but if I was a retiree, not wanting to manage my own portfolio, and I just wanted to generate income from a nicely diversified portfolio, and I really wanted to juice my yield, and I needed it for that capital, sure, I would have some, but I would have as little as possible that I needed. Ideally, I would get all my dividends from the other stocks, and I could just hold a low-cost growth fund like QQQ, SCHD, which is a good one, or even just a low-cost broadly diversified index fund, whether it be an S&P 500 one like SPYI or VOO, or maybe a biblically responsible one, which I would prefer, like BIBL or BLES, something like that. So again, hopefully this was helpful for you. If it was, please subscribe to the channel to get more content like this. Also give it a like. That helps me get this video more distribution, and it's an easy, free way for you to give me some gratitude for this video. Thank you so much. I really appreciate it. See you next time.